Hello everyone. In this video I will talk about value factors. As discussed earlier, factor is the common characteristic that a group of stocks have in commons and it derives the stock returns. Similarly, value is one of those common characteristics that derives the stock returns. Hence, it is called value factors. Now let's see what is the underlying principles, underlying philosophy behind the value factors. Underlying philosophy of value factor is that the financial market systematically misprice security due to investors' behavior like overreaction, negligence, etc., due to which value stocks are cheap related to its fundamental. So, it is better to buy undervalued stocks. You might be heard of value investing in the speech of Warren Buffett, etc. So he is focusing on such a stock. Now let's see how we can choose undervalued stock over a range of stocks in our universe. Consider we have a universe of 500 stocks, Nifty 500, and we are interested in building a portfolio of 20 stocks. And the style of investing should be value, means each and every stocks that we are going to select should be valuable. Value can be quantified by any one of these three factors. One is price to earning, other is price to book, and third is price to sales. Generally speaking, when we are saying value stocks, we are quantifying it by price is to earning. So in this video I will consider this price is to earning as a value factors. Why this way is works? Because when you go over the institutional investor like mutual fund, pension fund, insurance fund, they are also using other like price to book value, price to sales as an indicator of the value investing, because they have to build a large portfolio and they want something which is unique in such a way that risk of overall portfolio should be reduced. So when they are backtesting it with this variable, their overall funds, overall portfolios have better Sharpe ratio. That's why they might choose this or this. But generally speaking, many people, many investors choose price to earning as the indicator of the value. So let me ask you questions. Do you need lower value or higher value for undervalued stock? Think it should be lower. Why? Because earning is depends on the company's performance, and this price is done by the investors. If there is a lot of demand, then price might be high, kind of thing. So if it is less, it means the price at which it is being sold is lower, and it is advisable to buy that stock at that price because its value is even more, and in the future it is going to be higher price. So let's say that for our portfolio we are taking the same V1, that is price to earning. Now you need to take every stock from 1 to 500 and then take the price of each and every stocks. Let's suppose that we are building a stock at month end. Okay, so let's say or t is equals to t naught. So we will have the price at that point of time. So we will have earning from the last quarters, and we will calculate P by E ratio based upon P and E. Okay, and then once we will have P by E ratio for all the 500 stocks, we will sort the stock based on variable V1. Okay, so we will sort the stock on these factors, on this column. Once we will have these sorted value, we will choose the 20 stocks whose rank is higher, considering that lower value have a higher rank. Okay, let's see how different types of portfolio we can build from these 20 stocks. One is equivalent portfolio. In this method, we are assigning equal weight to each and every stocks in the portfolio. Since there are 20 stocks in our portfolio, so the weight will be 1 by 20, that is 0.05. Means if we have 100 rupees to allot to the 20 stock, then we will allot 5 rupees to each and every stocks. Second method is mean variance theory. So we have the stocks, we are not aware of weight. So we'll calculate expectation value of P, that is portfolio returns. So this is P is the expected value of portfolio's return, which is equal to summation of expected value of each stocks, and that expectation you have to estimate from the past data and based upon your analysis. You can also use machine learning models, any models, to estimate the price of the to estimate the return of each stocks. And then similarly you will also calculate variance of portfolio, which is equals to W star times covariance times W, and the objective is to maximize the Sharpe ratio, which is equal to expected value divided by variance of portfolios. And the point at which this variable Sharpe ratio is maximum, the corresponding weight will be the optimal weight corresponding to which there is a highest Sharpe ratio, and that W star will be our solutions. And this is the second way through which you can build a portfolio. You can also build a portfolio based upon the market cap. So if there is a, let's suppose market cap is M1, M2, M3 dot M20, okay, then the weight assigned to stocks I is equals to market cap of that I stock over divided over summation of each stocks. So it will be the weight. So weight assigned to ith stock is equals to market cap of ith stock divided by summing over market cap of each and every stock. So summing over all these values. Okay. Now let me ask you a question. There is one more method through which you can build a portfolio, that is weight proportional to the variable V, where V is that value factor, if you could remember, right? So how can you make a portfolio where the weight of a stocks depends on the variable V? So if you know the solution, you can comment below. I will try to look into it. Thank you.